Hello, and welcome back to Beyond the Charts. This series is where we break down what's happening in the world of finance and economy through charts in a way that's easy to understand. I'm your host Samdarsh. For all the charts and sources mentioned in this video, don't forget to check out our newsletter. The link is given in the description below. See, 2025 has been a tale of two markets. Globally, equities are enjoying one of the strongest runs in years. The MSCI Emerging Markets Index is up 17%, which is its biggest run since 2017. The S&P 500 has gained nearly 15%, besides which Korea has surged 41%, Germany 35%, and Brazil 21% in dollar terms. India, on the other hand, has barely managed 3 to 4% gains this year. That puts it near the bottom of the global leaderboard, as this chart from Motilal Oswal shows. A lot of it comes down to the US dollar. The dollar index has fallen by 8% this year, and history shows that how emerging markets usually shine when the dollar weakens. JP Morgan notes that investors poured about 16.3 billion US dollars into emerging market equities in July alone, which is the biggest monthly inflow in over a year. The weaker dollar has also boosted returns through currency effects. Roughly 7% of Korea's gains and 12% of Latin America's this year came purely from dollar depreciation. India, though, hasn't captured the same upside and has seen the contribution to the global market cap slip to 3.6% from a peak of 4.6% in February last year. So, why hasn't India shared equally in the global rally? The simple answer is valuations and flows. India has long been one of the most expensive markets in the world. The MSCI India Index trades at a 65% premium to MSCI Emerging Markets on price to earnings ratio. When cheaper opportunities opened up in Korea, Taiwan, and Brazil, global investors rotated money there instead. At the same time, foreign portfolio investor or FPI positioning in India is at its weakest since 2000. Domestic investors through SIPs and mutual funds have stepped in. Households now own 18.5% in the market compared with 17.3% for FPIs, but the lack of fresh foreign flows has kept India's relative performance muted. In dollar terms, DIIs have infused a record $83 billion since September 2024, which is more than the offsetting FII outflows of $27 billion. August 2025 alone saw the second highest monthly DII inflow at $10.8 billion, even as FIIs pulled out $4.3 billion US dollars. On top of valuations, trade frictions have added to the headwinds. The US has imposed a 50% reciprocal tariff on India, which is among the steepest faced by any major economy. The GDP level impact of these tariffs look modest at minus 0.2% to minus 0.8%. But sector level damage is sharper, with textiles, gems and jewelry, and seafood exports taking a hit, as per this Motilal Oswal report. Market performance has been uneven across segments over the last 12 months. Large caps fell 3%, mid caps slipped 6%, and small caps dropped 11%. Earnings, however, tell a different story. Mid-caps have delivered stronger earnings growth than prices suggest, which is led by real estate, capital goods, pharma, and also private banks. On the policy side, GST reforms announced on 3rd September didn't move the markets as much as it should have, but they could support consumption and earnings in the months ahead. The new structure simplifies rates into three slabs: 5% for essentials, 18% for most goods, and 40% for luxury and sin items. For a deeper breakdown, check out the Friday's episode of the Daily Brief. To add some structural context, Morgan Stanley calls India a low beta market. It falls less during global downturns but lags during bull runs. Exactly what we've seen in 2025. At the same time, India's policy stability stands out against peers. On their index, India has among the lowest policy uncertainty scores, supporting its long-term case even if the short-term flows remain volatile. To sum up, Indian markets have lagged global peers, held back by high valuations, weak foreign inflows, and tariff-related uncertainty weighing on the sentiment. Domestic investors, however, have stepped in to keep the market stable in the absence of FIIs. With GST reforms likely to boost consumption, it might help improve the sentiment. Now on to our second story. When we talk about India's economy, the spotlight usually falls on cities, but nearly two-thirds of Indians live in villages. And what happens there shapes everything from company earnings to government policies. The last few years, though, have been tough for rural India. Ambit Asset Management's August 2025 newsletter calls the past 3 years particularly challenging as wages barely moved up, prices of essentials shot up, and the demand for two wheelers, soaps, packaged food weakened. Families cut back to just the basics. Take inflation, for example. During COVID, rural inflation soared up to about 7.5%, which is much higher than the long term average. At the same time, farm and non farm wages stagnated. For many workers, real wages, basically, which is income after adjusting for real prices, actually fell. That meant that less money left in pockets, smaller savings, and lower spendings. Two of the best indicators for rural prosperity are tractor and two wheeler sales. Together, they tell a clear story. A rough patch followed by early signs of recovery. From 2019 to 2025, tractor sales grew at about only 3% annually, well below the 7% long term trend. There was a brief jump in the financial year 2021 to 2022 after good monsoons and post COVID pent up demand, but that didn't last. Now, two wheelers show the same pattern. Around 56% of them are sold in rural India, mostly in the sub 110cc entry segment, but this segment still hasn't returned to the financial year 2019 peaks. Prices for entry bikes are up by around 35 to 40% since then, due to emission upgrades, safety norms, and higher costs, while rural wages barely budged, making upgrades harder. The good news is that this downbeat trend might be changing. By the financial year 2024 and 2025, volumes have started picking up again. Tractor sales were up by 9% on year in June 2025 and 8% in July. Two wheeler sales also saw a mid single digit gain. Early signs suggest that rural households are beginning to loosen their purse strings again. FMCG companies like HUL and Dabur, which saw weak rural demand in the financial year 2022 and 23, are reporting some recovery as consumers are back to larger packs. Now, rural housing construction is also showing signs of life, helped by easing input costs. The monsoon this year has been kinder, rainfall has been slightly above average and better distributed. By July end, Kharif sowing was up 8%, which is higher than last year, setting up the stage for stronger farm output and incomes. On the other hand, wages too are improving. After years of stagnation, real rural wage growth turned positive in mid 2025 thanks to lower inflation and more government spending on rural infrastructure. Demand for Manrega work has even dipped, which usually signals better job availability elsewhere. Credit is flowing more into smaller towns and villages too. Between financial years 2019 and 2025, the share of outstanding housing credit going to rural and semi urban India has edged higher. So it looks like the rural economy, which had been stuck in a slowdown, is finally turning a corner. That's it for this edition. Thank you for watching and do let us know your feedback in the comments below.